So I guess now good afternoon, East Coast, good morning, good evening, depending on your time zone. Thank you for coming to our panel discussion titled, Should Biotech Bother with Early Stage Collaborations Given the Hot Financing Market? Each quarter, our team at Locust Walk compiles key statistics and trends on strategic transactions and financings. Our 2021 Q1 report, Global Trends in Biopharma Transactions, applies the latest data to analyze current activities in the life science deal landscape. For this quarter's webinar, we'll be discussing the nuances of early stage collaborations relative to recent deal flow. We have 1 hour allotted to the panel, including questions that we have prepared in advance, as well as questions received in advance from participants. If you have any questions you'd like the panelists to address, please submit them through the Q&A system. I will read out the most frequently asked questions and ones that have the broadest applicability to the audience, either at the end or interspersed with everything else. If we do not have time to address your question, we'll certainly follow up separately with our thoughts. We will and are recording this session, and a playback will be available shortly afterwards for all attendees. I'm also obliged to share that due to confidentiality obligations and other regulatory requirements, we will not address questions specific to any one company besides perhaps where the panelists currently work. They are also, in some cases, also members of public companies, so they will have some restrictions on what they can share, and we'll leave that to them to police themselves. This is also not considered legal advice for Lucinda or Andy's purposes, or an offer to buy or sell any security. Anything discussed in here is considered off the record. So to set the stage for the panel, just briefly, biopharma has experienced a record number and value of private financings over the last year and a half, while the volume of licensing transactions has remained relatively flat. These early stage collaborations are typically a mainstay approach for high growth biotech. On one hand, such deals help advance early pipeline assets, they help raise company valuations, and they also tend to be non-dilutive transactions. On the other hand, managing partner alliances can cause a distraction for early stage companies that need true capital resources, but also need to manage their people resources. Should biotechs really bother with early stage collaborations, or should they just simply focus on raising money given the hot market? To answer these questions and many more, I want to thank the panelists who have joined this discussion. I will introduce them each briefly, and then we will dive right in. So starting with Nana Bessin, there's a CBO for Insama, a company focused on in vivo stem cell modification technologies without the need for prior conditioning or stem cell collection. I'm sure there's more to it, Nana, but that was the best I can do in one sentence. Nana has nearly 15 years of life science experience in corporate and business development, strategic planning, operations. She was the chief of staff to the CEO at Intellia, a genome editing company, where she led a wide variety of strategic initiatives across the business. She also worked in BD at Shire and Sci4 Life Sciences. Welcome. Matt Hawryluk is EVP and CBO at Gritstone, an immuno-oncology and infectious disease company with a focus on tumor-specific neoantigens and viral antigens displayed in the surface of viral infected cells. Prior to Gritstone, Matt held positions of increasing responsibility at Foundation Medicine, most recently serving as VP, Corp and Business Development. He also held roles in BD, marketing, product management across the divisions of Thermo Fisher Scientific. Welcome. Andy Meyerson is an SVP and the head of the North American Strategic Transactions Group at Locust Walk, which, for those of you who don't know, is a global life science transaction firm. Prior to Locust Walk, he was a corporate attorney at Gunderson Detmer, Wilkie Farr & Gallagher, and a banker at Credit Suisse. Separately, if any of you are interested in any funny stories about Andy, I have several I could share offline, and maybe you can figure out for yourself how I might be privy to them. Welcome, Andy. Last and certainly not least is Lucinda Quan. She's an EVP, CBO, General Counsel, and co-founder. Lots of descriptors to her title at Alogos Therapeutics, a company developing targeted curative therapies for hepatologic diseases and viral infections, including chronic hepatitis B, NASH, and hepatocellular carcinoma. Prior to joining Alogos, Lucinda served as Executive Director of Transactions, Business Development, and Licensing at the West Coast Innovations Hub at Merck, as VP, Head of Legal Affairs at Alios Biopharma, which was acquired by J&J, and VP Legal Affairs and Associate GC at Intermune, which was acquired by Roche, sensing a trend. Prior to Intermune, Lucinda spent several years in private practice at various law firms. Welcome, Lucinda. Well, now that we are all introduced, let us dive in. So, Nana, we'll start with you. If you don't mind sharing a little bit more about Insomnia as it relates to your strategy and how partnering fits into it, that'd be awesome.
Sure. Thanks, Jeff. Thanks for having me today. And it's Insoma. As you mentioned, we are focused on in vivo gene modification of hematopoietic stem cells and cells that arise from them, such as T cells, B cells, and myeloid cells. BD is an important component of our overall corporate strategy to ensure that we're accessing enabling technologies and tools necessary to further our own pipeline, as well as to realize the broader potential of the platform. So I think we certainly realize that with the platform that we have, that there's a lot of application, and we won't be able to do everything on our own. And so we've been very clear about, as we're building the company, and we'll continue to be clear about where we want to focus our own internal efforts, and where we want to grow the business, and also look for other synergies with other parties to give us the opportunity to expand the reach of the platform, and also to continue to partner.
So maybe on that note, maybe you can talk about the deal that you've done and how that fits into your strategy going forward.
Sure. We are so pleased to have recently launched with both our Series A and with our collaboration with Takeda. It's off to a great start. As you can imagine, we're very focused on building the team and our capabilities and delivering on the commitments that we've made so far. But having said that, again, that there is a lot of potential for the platform, and so we do look forward to continued interest from other partners, and are exploring and will continue to explore other strategic collaboration opportunities. But for right now, I think, we're feeling very good about having our hands full, and the Series A funding and the non-dilutive funding that we've received from Takeda certainly gives us the runway to get to, our major inflection points, get moving our first programs to pre-IND, to advancing the rest of the platform development, and also thinking about how to more aggressively think about innovations on the platform as well. And I think the Takeda collaboration has certainly allowed us to think more aggressively in that sense, which has been great.
Yeah, it's awesome. We'll definitely talk more a little bit later in the panel about some of the trade-offs of the distraction versus the benefits of a partner. So thanks. So Lucinda, maybe I'll go to you next. So if you don't mind sharing a little bit more about Alogos, and again, how early stage collaborations might fit into your strategy.
Yeah, so thanks, Jeff. So again, we are a biotech that was formed in 2018, and our initial focus is on developing novel therapeutics for viral and liver diseases. Our team consisted of members with proven track records and have worked together for years and years, if not decades, in prior organizations. And because of this, we've been able to move relatively quickly from a discovery stage to clinical stage, and amass a fairly notable pipeline, especially in the HBV space as well as in NASH, in just 3 years term. So in terms of how BD kind of fits into our strategy, from prior experience in prior lives, I mean, we really, when we started the company, we really did focus on using the chemists, the very talented chemists that we have, to develop or discover and develop assets that we are deliberately going to plan to partner. For instance, initially for our NASH THR beta program, we weren't planning to really take that into later stage development. And, it's just a matter of, when might be the right time to partner. But, it's also a great asset to have in terms of hedging in case any of our other programs, suffer some setbacks. So it is always something that we have in the back of our minds. Our initial focus, though, really is kind of moving our programs, our HBV programs, through clinic.
Got it. So what went through your, I mean, so you went public, I believe, not too long ago. So how did you think about partnering relative to the IPO and the importance or not in that decision?
Yeah, I mean, so again, our assets, we started the company with nothing. So it's not that, we acquired a later stage or close to clinical asset, and we were, we were going to do something with that. It's more of all of our assets were, again, we most of them are discovered in-house. And so we didn't really think so much about partnering. We had entered into a partnership with Merck, and we started discussions with them actually around the time of, our IPO. And, there was some like discussion back and forth about whether or not this Merck deal, would be additive, beneficial to the IPO or a distraction. At the end of the day, we did our IPO before we signed the dotted line with Merck, but that collaboration is going well, and we're thrilled to be working with them.
Cool. Very, very interesting. And we'll dive more into that, the capital trade-off between partnering and financing shortly. Matt, so you executed also a deal relatively recently. So to the extent that you could share a little bit about that deal and how that fits into your overall or maybe evolving strategy, that'd be great.
Yeah, so maybe thanks again for the invite. Maybe just a brief moment on a bit more background on Gritstone Bio now. So we're a clinical stage public company, and we're developing, we view as next generation immunotherapies that are against multiple cancer types, as well as infectious diseases, which is a new therapeutic vertical for us. As Jeff briefly mentioned, our products are developed leveraging basically two big pillars. First, a AI or machine learning based platform, which we call Gritstone Edge, which is designed to detect antigen or predict antigens or epitopes that are presented on cells, which can either be for tumors or virally infected cells. And then second, the ability to develop and manufacture potent immunotherapies. And these are two different vaccine platforms proprietary vaccine platforms that we have that take these antigens and then drive a potent immune response to attack those disease causing cells. On the oncology side, which we're not going to talk that much about, but we have two programs that are leading on the oncology side. First, a individualized, N of 1 manufactured neoantigen-based immunotherapy, which we call Granite, and then an off-the-shelf shared neoantigen therapy, which we call Slate. Both are in the clinic now. As you can see, we like the rock theme. And then on the infectious disease side, we're advancing program Coral, which is a COVID-19 program to develop a second generation vaccine with the support from NIAID, which is a division of the NIH, and then the Gates Foundation. And then the last aspect that I want to highlight is really our how we essentially launched the infectious disease vertical, and that was with a recent Gilead deal that we did at the end of January. And a bit of background there is, this is a collaboration to develop a transformative curative HIV treatment. And I think when we were thinking about this space, this collaboration is basically bringing excellence in HIV coupled with a clinically validated best-in-class vaccine platform. Clearly, Gilead is the market leader in developing and commercializing HIV therapeutics. I think they own, vast majority of almost a $30 billion HIV therapeutics market. And we were bringing a differentiated vaccine platform that can drive robust T-cell responses, as well as memory responses. And I think we viewed that a collaboration was taking this asset and putting it in the hands of the best owner in the world leader in HIV. We were prior to this year not an infectious disease company, and I think part of the strategic decision for us to partner and do an option and license agreement with Gilead was, they know the space, they're world leaders in the space, and there's always finite bandwidth and capital in a small early stage biotech company. And we thought it made a lot of sense for us. And just maybe one more moment on the Gilead transaction. The structure is an option and license agreement. And from an economics perspective, it was $60 million upfront with milestones and royalties downstream. I think the other thing that was mentioned earlier was the distraction, and Lucinda mentioned this. I think we thought a lot about this, and I think one of the things that made this transaction attractive for us is that Gilead is actually conducting and running the phase 1 study, so it wasn't a big burden from our small but nimble clinical development team.
Interesting. So this is a way for you, it was a way to launch a new vertical, which is interesting because most platforms have applicability in more than just one area. And most companies don't have the people or the capital to exploit them more broadly. And so that's the age-old question. How much do you diversify, and distract versus get capital and maximize the value, et cetera? And so you guys made the calculus to go into a second vertical to basically launch that. And so do you have plans, to the extent you can discuss it, to do more in infectious disease as a result of this shift and build capabilities yourself, or are you going to try to do it through partners?
Yeah, so I think in Q1, we actually had 2 large infectious disease announcements, which were the launch of the COVID program, our Coral program. And we did that also in partnership. So we launched the COVID program with partnerships from the NIH and the Gates Foundation. So that's our program. It's a fully owned Gritstone program, but we partnered with the NIH for the trial, and the Gates Foundation we did some early preclinical work with them. And then on the HIV side, I think that was an area that we did evaluate whether to do this work internally and to move this program forward. But for us, it was obvious. There was I think a great match in Gilead, and the fact that they are, in our views, the best owner, world leaders in HIV. They really understand this space. And since they're funding and doing the phase 1 work, it did not distract from all of the other important work we're doing at Gritstone. So I think
makes a ton of sense. So Andy, just to piggyback off of that, I know that you and Matt worked together on the Gilead deal, so I'm not going to make you comment on anything that Matt's already said. But between that and the other transactions you've been involved with, how do you think that early collaborations should potentially fit into the financing landscape for a company, again, without having the specifics of a company to discuss?
Yeah, absolutely. And first off, thanks to Matt, Nana, and Lucinda for joining the panel. It's good to see all of you again. It's been a while. But I think that really what we've heard from all 3 panelists already is fundamentally coming down to a key question that anybody has to ask as you're heading into a partnership, whether it's an early stage collaboration, a late stage collaboration. And it's really, why are you doing this? What is the goals of the partnership? What are you looking to get out of it? Are you looking at it as a financing mechanism? Is looking for validation of the platform? Is to acquire capabilities, which matches each of the reasons why Lucinda and Matt have each done their deals. But then also thinking through, okay, if that's what your goal is, what is really the way in which you're best off going about doing that? And so I know, at least with Locust Walk, one of the things we always ask first before, when someone comes to us saying, hey, I'm looking to do a deal, is why? What are you looking to get out of it, and what is it going to do for you down the line? If it's to generate additional financings, okay, what do we have to do if that's what you want to do? If it's to find somebody who can pick it up and run with it because you don't have the ability to push further into clinical development, okay, what does it actually mean in terms of how you're going to go about doing that? And so I think the overall issue with BD as it relates to financings is, how do the 2 operate within each other? How does one play off the other? I know we're going to talk a good bit about this later on in the panel. But really, how do you use BD to drive the overall corporate development of the company, of which financings is also only one part?
Yeah, and so, but I guess the financing takes most of the headlines, because you see a big upfront dollar value. People think about the money. They don't often think about the validation, the capabilities, the maximization of the value of the platform, et cetera. And I guess we fell into that same trap for titling this panel about partnering early stage versus financing. So I will hit that a little bit little bit harder. So I guess just to be direct about it,
Mhm.
in a free-flowing environment where the capital spigot is theoretically turned on, although I think there might be some jitters of recent days, especially compared to the last decade. How does an early stage BD deal compare if you can just raise equity capital at increasing prices? So notwithstanding the other reasons for doing it, but from a pure financing perspective, how do you guys think about BD as a financing tool? I don't know, Lucinda, why don't you start this one?
Yeah, I mean, BD as a financing tool for early stage, right? It's worked for members of my team in the past. But at the same time, early stage deals don't always generate huge amounts of money, right? For us, for instance, the money we would get if we partner an asset earlier, we're in clinical stage. We have 2 programs in the clinic and another 2 going in later this year, and then probably another couple of following years. That's really expensive. So, it's to me, it's a great to have, but, it really depends on where the company is, right? I mean, I can tell you stories from, the prior company that my team was at, Aleos Biopharma. They started in 2006. 2008 was a horrible year for financing. Luckily, there was a bunch of strategics that were very supportive and did the Series A round. But they had an HCV asset, and HCV at that time was what was hot, but they were a little bit behind. But they were able to, with a deal, an early stage deal, they were similar to Matt's deal. Like, they were able to get like a 60 million upfront, and that really sustained the company until their Series B. And pretty much right after the Series B, it got acquired by J&J for 1.8 billion. So it just depends on the where the company is and the environment. So it could play a very big part, or it can play a small part. I mean, for our company and our collaboration with Merck, for us, I mean, the main goal really was that it was an external recognition of the novelty of our oligo platform and capabilities, and that was a huge thing. It wasn't necessarily for to generate a lot of money for us for the upfront, because again, this is like a discovery stage. So we don't even have an asset yet, except for utilizing our platform.
Well, I guess also some of these discovery deals, they're giving you upfront, but they're then expecting you to spend the money on their platforms. So the excess capital does not actually show up in what's the headline number.
Nope, exactly.
So just a quick follow-up on that, Matt. I mean, without pointing fingers at stock prices, stock prices for some companies have come in, and no CEO I know typically loves their stock price. So how do you think about partnering as a means of getting capital less dilutively now that you're a more seasoned public company?
Yeah, I would say I think most of us know this, but you're taking dilution either way, whether it's equity dilution or asset dilution as part of a transaction. So you have to think about both of those things. And for us, with the Gilead transaction, I think it was there's always hiccups. I would caution people, BD, it's hard to make BD your financing strategy. And I would just be very, very careful about that. It is not a financing strategy because BD, can ebb and flow. Big pharma companies, your champion may leave unexpectedly. They may undergo a strategic evaluation of the space unexpectedly and throw your timelines off. They're on their timeline. In a small company, obviously, time and cash are precious, and you're not driving that timeline. So, that is just something always to keep in the back of your mind, and something I would caution, some of the people here, that the panelists I'm sure know, is, BD is hard if that's your mechanism to bring in capital. I think BD is a great tool in your toolbox. Sometimes it can bring in that capital when you need it. But you don't want to be in that position where you're making trade-offs where, if you're a platform company, something we were always conscious of is we couldn't encumber the platform or other programs or the asset in other verticals as part of this transaction, which was non-core for us. And that was, I think we inked the deal. We were very, very happy with the partner, but that's something just to think in the back of your mind when you have a platform company and when you're doing a non-core deal. And in many ways, I think those are the hardest deals to do. Single, a small molecule, those deals are not always easy, but, you can ring fence that asset in a much easier way than you can ring fence a platform company. And you don't want to contaminate other things that the company is working on that are much more core. And just to piggyback onto Lucinda, for us, again, this made a lot of sense because these were dollars that came in that were in many ways, since we were not running the phase one, we were not incurring a lot of those expensive costs as part of this deal. This was capital that could come in to fund other activities within Gritstone, which was very, very attractive for us, and things that we could fuel, our nascent infectious disease franchise.
Yeah, so it was in some ways an out license where the program was transferred over to someone else. You get the benefit, and you didn't encumber the platform. So it seems like it was a win all around. You got capital, you got someone bought shares at a good price, and ultimately all of your objectives were accomplished, it sounds like.
Yeah, and I can't understate the validation. I think that the external gold-plated kind of stamp of approval on a platform was important for us. Investors still very much look to those big pharma stamps of approval. So that was an important aspect of the deal as well.
So Nana, just piggybacking off of that, thinking about validation and the impact for investors, when you're thinking about how you decide to encumber or not your platform, how does that calculus play for you and the impact it might have on investors as a private company?
Right. I wholeheartedly agree with what Matt shared. BD is not on its own a financing strategy. And when we initiated our outreach, we really were approaching it more as a way of obtaining feedback on the platform. So that's something else, BD it is very valuable to go out to larger pharmas. And, these are folks that have some deep subject matter expertise, especially in their areas of focus, where being able to take, some of that insight and bring it back inside to your company to think about how you're sharpening your value proposition and how you're thinking about positioning is really valuable, whether you do a deal or not. And so we really were, wanting to explore whether there was interest, but we certainly didn't go into it feeling that a deal was a requirement. We were, we absolutely knew that a financing is something that we intended to do and needed to do. As I had mentioned previously, we went into those conversations as well, being very clear about the areas that we needed to ring fence. And as a result of that, there were a number of partners that then kind of dropped out in terms of progressing, any discussion around a collaboration because we were clear about that. And Takeda was a really attractive partner for us for a number of reasons. Certainly they're an established leader in the rare disease space with a significant clinical experience. We're just starting and getting going. They've got a global footprint and a shared commitment to patients and global access and development of transformational medicines. But not to be underestimated as well was the alignment early on that we had between our scientific and business leadership on both sides. And so, we really viewed, our Takeda deal, it is validation of our platform and our approach. And it was a positive as we went forward and talked to potential investors. And essentially, we're running both processes in parallel. So also to Matt's point, like BD, it can go, you can be ready to sign. And I've seen that happen, right? You've got the final executed document and either the board doesn't approve. You're competing with another deal, some other mega merger, and you're not aware. So again, you can't count on it, even when you're going through the whole process and everybody in good faith is working towards that end. When we're thinking about building the company and the resources it's going to take, I don't think that's something that you can always count on. So
yeah, you got to control your own destiny. And I guess maybe just to go off of that, I mean, thinking about maximizing the value of the platform, that was something that I forgot who brought that up. And Andy, for you, I know you see a bunch of this at Locust Walk. How do you think about advising a company? What would you say to them about, I have this cool platform, it can do a lot of different things. There's distraction versus economics versus validation. You could spin things off, you can partner non-core assets, you can partner the lead. How do people make those decisions? And how do you maximize the value of a platform that you as a company wouldn't be able to do on your own?
Yeah, I mean, it's a great question. It's something that we come across actually more often with public companies than we do with private companies, though the rationale for why is exactly the same. And that's when you're raising capital, the investors are putting their money in on a specific thesis that they're investing into. And so if you try doing anything outside of that thesis, it starts to raise some questions in their minds in terms of the investment overall. If you're private, there's always a guaranteed use of, well, not guaranteed, but a clear use of proceeds, which is being highlighted in terms of what you're looking to fund. And if you're public, similarly as well, when you're out on the roadshow, there's things that you're talking about, and that's what investors are investing into you for. And the reality is, as a public company, and you look at your stock price, you're likely only really being valued on the actual clinical programs you have or the most advanced programs that you have in the platform, and that's really what's driving your stock price. And so everything else that you can do with your platform, you're not necessarily going to be getting a lot of credit from it, at least within the public markets, or in a private company, you don't have the capital to pursue it because that wasn't what you were given the money to do. And so a lot of what we've been seeing more and more frequently is companies recognizing this and saying, well, how am I actually supposed to get the value that I know exists within my company? How do I actually do something which is going to enable me to find additional sources of capital or additional areas of collaboration or whatever it is? And what we're starting to see happen from particularly platform companies that have been around, they've been public for a couple of years, is seriously starting to think through, do I pursue a spinoff where I can create a new company with its own thesis that could be independently financed, or do a collaboration in an orthogonal therapeutic area that's non-core to what it is that we're doing, knowing that we can still get the value, we can still pursue it, but it's something which we don't necessarily have to devote all the capital into, or even thinking through all other alternative structures along the lines of those two. And it's something which I think any company, that's really a BD type discussion, especially because if you're going to start a new company with an alternative thesis, who's going to run it? How's it going to be capitalized? How are you going to ultimately look to grow that company if it's going to be independent? And it's really the only way, unless you're planning on really doing it yourself, because you have enough capital internally that you can do that. Investors are understanding of what it is you're trying to do. You're almost left with little choices other than either pursuing a partnership for some of those non-core assets, spinning it off into a new company, or doing something else creative that allows you to unlock value in a place where, to be quite frank, the public markets aren't really looking for you to do it yourself.
So that's interesting. So we did a white paper a couple of years ago talking about the value of partnerships and the impact on stock prices. And what we found is the partnerships that were the least expected from the market were the ones that provided the most lift, because obviously it's a positive surprise. You get more cash, that's a surprise. If it's a secondary asset versus a primary asset, better surprise. So that's just ultimately an offshoot. It sounds, Andy, like from your corporate strategy, are you okay just deciding not to focus on certain areas of your platform and just focus on what you're good at, or can you extract value from them in other ways? And is that worth even the distraction of executing against it? Is that a fair summary of what you said?
I think that's exactly right. I mean, obviously, if you're going to pursue any type of corporate transaction, whether it's a partnership or a spin out or anything, there's going to be a distraction, not just from the business team, but also the scientific team. And anything that you want to do needs to be properly strategic, and that requires an alignment of what it is that people are looking to do. And it really needs to be something that, especially if you're going to raise money into it or try to do a partnership, you have to be able to explain, here's what my plan is, and here's what I'm looking to do. So you're essentially creating an entirely alternative business plan to the core of your company, which is vital if you want to try to get that type of transaction done, but it's also true that it's really the only way you can potentially extract that value, unless you're planning on deciding, you know what, I can't do that. I want to focus where I'm at. I'm going to stay in my lane, and I'm going to be successful in terms of what I'm executing against.
Yeah, no, they're both valid choices. There's no right answer there.
Yeah, completely.
So I'm going to switch gears slightly, and then I'll go around the horn again. I hinted at this, that there are some, I guess I'll ask you, Andy, are there any changes in the markets recently that might impact partnering? And then we'll go from there to talk about the investor impact from partnering. So maybe you can kick us off, Andy.
Yeah, absolutely. I mean, I think that what we've really seen over the last couple of years, and then I'll talk about the last couple of months, is because financing was relatively available compared to the previous periods, there was a preference that was towards doing the financing versus doing the BD deals. And what we also have seen is some decrease in some levels from the strategic buyers in terms of doing some deals because prices are higher, because companies can get the valuations that they want in the financings or their equity premiums or whatever else. What we've seen in the last couple of months, particularly starting probably around mid-February or so, is I wouldn't call it a decrease or anything else. It's more of a softening in the financing markets in terms of the overall interest in biotech, as the economy overall has continued to open up as we've recovered from the COVID pandemic. And what that softening has done is it's in some cases made the financing market a little bit less certain for certain types of companies. IPOs are still happening, but maybe not to the same fervor as they were before. Private financings are still happening, maybe not quite to the same levels they were before. They're just taking a little bit longer or whatever else it is. And so what we're starting to see now is it increases the importance for having those BD transactions, whether it's as a source of non-dilutive capital, whether it's a source of the validation necessary in order to make sure that you are able to differentiate yourself as a company seeking to raise capital, or really anything else. Especially if the financing market does actually cool down, that's going to certainly potentially have a dampening impact on the pricings. We're going to see an increase in likely buy-side activity from the companies who have been sitting on a lot of cash wanting to do deals. They just don't feel like they can get the right type of collaboration. We've seen a lot of early stage collaborations because the pricing isn't quite as bad on those in terms of upfronts and downstream, but we may start to see more of those mid-stage or even M&A type deals, which are still driven by BD.
Interesting. So I'm going to start on this one with Matt. I want to be fair to all in the order. So how do you think the investors are reacting to deals and the impact on your company and on your strategy? Because I want to make sure that we address that side of the house, because that's clearly important.
Yeah, I think I think the comments you made at the beginning, Jeff, and around the data and the white paper, I think that still holds, right? I think for our company, I think was largely valued on the oncology assets, and when we and I think we at some point we will present data, and that will tell that story. And I think there was very little data ascribed to the platform outside of the oncology assets. So for us to do a deal and make a statement saying, and now it's in models within analysts, that there is an infectious disease asset here that is now in the hands of a very capable big pharma partner to drive it forward and hopefully successfully commercialize it and pay their rents back to Gritstone. I think it does put an important seed in, well, wow, this company was able to do a deal on a platform in an area that we were not expecting. There may be more of these. So whether that ends up in the model today or in the future, it's now not, it's something that we've planted a seed in investors' minds, whether it's the analysts or whether it's the actual investors themselves, that there is additional value for a platform technology outside of the core clinical programs. And that could happen at any point. And I think that, that's what, so it was an unexpected announcement, I think, from a market perspective. We're pleased with it. We're going to be active in BD. So we'll see, what the next opportunity is that makes sense for us.
So it sounds like, just based on your experience, and if I recall, there was even a nice stock pop from the NIAID announcement, which again was not expected, not just the Gilead transaction. So
Correct.
I guess from your experience, would you say that it's worth exploring those orthogonal opportunities to get positive momentum, or is that just unique to your situation?
So I think it is. I think you should, back to Nina's point, having those discussions with pharma are always helpful, right? You learn in those interactions, and those pharma partners are smart, and whether it's and we've experienced this. We're going to talk about a particular clinical design. They have good ideas. Maybe maybe we take them or maybe we don't, but every interaction with a smart individual, I think, is helpful. So I think having BD dialogues, whether the end goal is actually partnering the asset or not, are actually helpful things to do. You get smarter, you get your pitch gets tighter, and it causes you to walk away and think about things with really smart people, and it's free. You don't have to pay for an ad board and get everybody together. I mean, big pharma likes to hear a pitch, and those are smart individuals, assuming you get them in the room. So I think I advocate. Now, there's a balance. There's always a balance. You don't want to be going out to those big pharma partners every month. You want to be thoughtful about the frequency of interactions. But I do think it's helpful, and I think from our perspective, maybe one thing I've learned is, if you have a platform and you have a pie in the sky idea, it's probably too far from a value inflection point for it to make sense with some partners, and you have to be thoughtful. For us, we had preclinical data and basically an IND ready asset in HIV for a whole bunch of reasons. So it was a point that made it easy to transact, or easier. There are other ideas which I think are great ideas, but are much, much earlier. And some pharma partners, for example, want an asset 12 months from clinic. That's their threshold point, or 18 months from clinic. And you have to think about that. So you may or may not want to spend your own precious dollars to take an asset to a point where it becomes an attractive partnering dialogue with a partner. And I think that's an important balance, because you don't want to spend money. I would caution companies to spend money just to get an asset where it's partnerable if you really don't have interest in taking that asset forward. It has to be on strategy.
Are you building and will they come? Kind of a thing. Totally agree. So Lucinda, how was your deal received by the investor community, and just maybe talk to you a little bit more about this theme?
Yeah, well, so I think it was actually a little bit of a surprise, because again, we did our IPO and then we signed our Merck collaboration, and the analysts, they a lot of them had the same question. So, are you thinking of doing more of these types of deals down the road? But going back to I think what Andy said, we're now a public company and we have this use of proceeds language in our SEC filing. So, we do have to, look at, similar deals a lot more carefully. It was a great deal. And ever since then, a number of companies came knocking on our door and said, hey, we noticed you have this oligo platform and small molecule platform, and these were companies who may not have maybe a strong, our research arm within their organization, and they want to talk to us about, doing something, leveraging our platform, using, for a target of interest that they might have. So it is, we have to balance, whether it makes sense, whether that, scientifically, first, that we can do it, that we're confident that something can come out of it with our platform, right? I mean, we'll be honest, if we don't think that there's any promise, it doesn't make sense, even if we get, a decent upfront. But also, is it going to be additive to our platform? And, the distraction, even when we were doing the Merck deal, there was a constant conversation on the board level of, does this make sense? Do you have the resources? Are you sure it covers your costs? And we would run the numbers. We would kind of have a game plan so that we can be confident that, we we can do it without the undue distraction to our company.
Interesting. And Nana, do you want to, even as a private company, think about how the investors, either current or potential, reacted to your collaboration?
I certainly, the fact that we're early and private, not public, certainly changes. I think some of the calculus, certainly. For us, I really do think the validation was key, and we also were doing this so early in our own planning that we were able to ensure that we were building into our plans the ability to execute on our own internal programs, as well as those that we'll be supporting for Takeda. I think so outside of the validation, I think it was probably very important for our investors to appreciate that we weren't completely locking up the platform. And so again, the areas that we feel are major value drivers for the company continue to be wholly owned by us. And in our deal with Takeda, we've granted them, exclusive worldwide access to our vectors for up to 5 indications off of a pre-agreed list of indications. So we still have plenty of room to continue to advance our own interest, as well as have optionality in the future to do 2 additional deals if they make sense. And so I think that certainly are things that the investors wanted to be sure of. And to everyone's point, I think depending on, what stage you're in, that whole question of, does this become a, validation versus is it a distraction? I think as we continue to progress, that's when more of that distraction piece is something we'll have to continue to work through. But we were early and able to incorporate it into our plan.
So that's interesting. One, I guess, observation that I'll make is if you do an early collaboration and you're effectively a glorified CRO for a bigger company, that is absolutely a distraction. However, if you can create an asset for yourself where you have opt-in rights, kind of 50-50 at some point in time, where you've created something strategic for yourself, then that might become a little bit more core as opposed to distracting. And I guess to Matt's point, if the other party's doing a lot more of the work than you are, you've kind of offloaded the distraction factor and gotten the economics in return. So that's maybe a prelude to, if you guys can share some insights into what does a bad deal look like? And sorry if I tipping off a potential part of the answer, but what do you want to avoid in doing a deal to make sure that you don't have the distraction, but you actually get the value that you're looking for? I don't know, Andy, do you want to kick us off?
Sure. I mean, I think you hit the nail right on the head already in the question. I mean, I think any deal where you have to spend your time and resources delivering against the partnership where you don't get much out of it on the back end. And so it's time and money that can't be used towards developing the core, which is really what's going to drive your future financing, because they have to be able to finance something, is a bad deal. I mean, I think if you talk to most BD professionals that are early in their company, there's a lot of times they'll say, I did that deal because it was the deal to do at the time, but I'd never do that deal again. And it's telling because, early on in the company, you're looking for the validation, you're looking for the capital, you're looking for whatever. But to your point, if you don't retain some sort of core right to something that's coming out of it, then all you've really done is delivered value to somebody else. And yes, you'll get compensated down the line, but it doesn't necessarily help you in the short term. If, to Lucinda's point from earlier, you don't actually have the money to do it yourself, and all they're paying you to do is their work for them. If you don't get any kind of incremental value on top of that, the deal doesn't do a lot for you other than showing that you're able to get something done. Now, I mean, from the purpose of the company, if you're able to build a capability, that's valuable if you didn't already have it. If you're able to retain rights, that's valuable if you didn't already have it. If it allows you to move into a new vertical, that's valuable because you couldn't have done it otherwise. And so you have to look at the pros and cons of all the deals, but a bad deal is one where you don't get much value out of it. You've delivered something to the pharma partner. They're very happy, but it doesn't really give you much in terms of an ability to either raise additional money, do additional deals, or make any kind of serious advancement on your own pipeline.
So I don't want to assume these 3 stellar CBOs have ever done a bad deal. So I'm not going to call on any of them directly unless they have an experience they want to share about something that they might have done differently. Amazing. All of you have done great deals. I had a feeling that was the case, so I will then absolutely move on. So one thing that I'll apologize to those in the audience who have a really cool small molecule program that's relatively vanilla down the fairway, but I'm going to go a little bit more high science here because I think that's where a lot of the market is going, and that's where I think our three panelists who are CBOs have for their own platforms. How do you think about doing deals with partners when you have a real novel platform that might not be on the BD shopping list for a pharma company or a big biotech? When do you kind of seek that out? How do you persuade someone, if that's what you want to do, for that validation if it's so cutting edge? Any thoughts?
Maybe I'll jump in first. I think maybe this is obvious to everybody, but there are a lot of BD groups have their BD shopping list, as you mentioned, Jeff. For something that's novel like this that may not be on the shopping list, you got to get a champion. You need a scientific champion within the organization, because the scientific champion, depending on how high they are, they can actually alter that BD strategy or the company strategy from an investment and partnering perspective. So I think our Gilead deal was driven by the champion. So it was an initial presentation we had with the champion, and it immediately resonated. And then it was the champion kind of pushing it through to the BD team and subsequent transactions. So I think that there's the two big routes, which are the BD and the champion. I've been a big fan of the champion in both my Gritstone as well as my previous Foundation Medicine careers.
Lucinda, do you want to?
Yeah, I mean, for us, right? Again, it's kind of interesting. We had set out to discover molecules for ourselves, right? For us to, develop into therapeutics. And along the way, we developed these platforms, but we didn't see ourselves as a platform company initially, until, a few board meetings down the road, they're like, hey, you guys have a couple of platforms. And the way that, we are kind of able to market this platform first, there's got to be some novelty, right? We have certain IP around it that, would give exclusivity to folks. But where we've been successful in attracting attention to kind of for other parties to leverage our platform is because we applied it to our own programs, and we're generating data from our own, programs. And so in that sense, it's novel, but we have something that's continually proving out that platform, if you will. Because I do think, again, data speaks, right? If you have something good and you have that scientific champion in the other company, and they can look through as a case study what you've done, with your own assets using your platform. I mean, that speaks volumes.
So is it fair to say that cutting edge, you can get an earlier deal, but bleeding edge, you might need to show a little bit more? Is that how you think about it?
I would say that.
Nana, any additional thoughts there?
No, I think this kind of gets to, how do you differentiate yourself as well? And I think in the case of Insoma, I believe strongly that we had kind of the trifecta, a transformative approach, technology that was de-risked, and also a very strong team. And I think those are the elements that on the other side, whether it's an investor or a potential BD partner, are the things that they're looking at. So, unlike a lot of companies at our stage, and certainly while we were in the seed stage and having these early discussions, we are a little bit differentiated in the fact that, our approach has been extensively validated in rodent and non-human primate models, and based on, over 2 decades of foundational research that happened with our scientific founders. And the approach itself, our in vivo approach is poised to leapfrog current ex vivo approaches that are out there. So I think those two pieces on their own, right, coming to the table with something that clearly is where the field is going, makes a big difference. And I think that also I agree with both Lucinda and Matt, that champion and having that synergy up front was also, when I think about our Takeda deal, was also very clear. So we, from the outset, had very strong alignment with senior leadership at Takeda, and that's also what helps drive deals forward.
Awesome. So we're getting close to the end of time. So I'll let Andy answer kind of the last question, then I'll get final thoughts from each of you. And just in the spirit of providing advice and experience share, are there any tricks of the trade or things to consider when structuring some of these early stage collaborations that the audience might want to look out for, Andy?
Yeah, absolutely. And I mean, there's obviously a long version to that answer, and I'll give you the short version, which is something I hinted at before, which is you really have to think through, what are my goals of the collaboration? What is it I'm looking to get out of it? So I think it's very important to pay close attention to what is it that you're going to do versus what is it that the partner is going to do. If it's something that they're going to do, is there a way to learn from it? Or how do you sort of build your own capabilities if you're using the deal for growth in some way to build out what it is that you want to do long-term for yourself? As it relates to the asset, I think that the data is pretty clear that it's important to retain some sort of rights to the lead, or maybe the second, but some leading program coming out of the collaboration overall, whether it's a co-pro co-dev or some sort of opt-in right, or any way to retain a right is going to be important. I think that the data, when you look at it, is pretty clear on that. And then I think also, if you're looking at the deal, and especially if it's a target-based deal for a platform, exactly how much are you going to really have to do? How many targets is it really going to be covered? And of those targets, which of them are the ones that you actually wanted to do yourself versus things which are more sleeves off the vest areas that you weren't necessarily interested in? Because if you're giving up too much of what it is that you wanted to do, you have to start to think through, what am I actually going to execute on? And if I'm giving up too much of the value of something which was going to drive the future success of my company, like what Lucinda was talking about, it may not actually be the right deal to do overall. And so I think that, especially for an early stage collaboration, retain some sort of right, understand the roles and responsibilities and how you're going to execute against it, and make sure that you're not accidentally giving up the core value of your company.
Cool, awesome. And maybe in 30 seconds each, any final thoughts of encouragement for the audience? Maybe Lucinda, if you want to start.
Yeah, sure. I mean, I wholeheartedly, agree with what all that Andy has said. And I would really also kind of just echo and really go into a deal knowing what you can give up and what you just can't. You have to have that pretty well set in your mind, because terms will be negotiated back and forth quickly. And you just don't want to agree to something that would actually hamstring your company down the road. But it's always hard, right? Bad deals are a little bit of 20/20 hindsight of what really is a bad deal.
Cool. Matt, go for it.
I echo, but I'm going to put an exclamation point on Lucinda's comment, because it really resonates with me, which is know where you can and can't go on the deal from day one, because for us, there were certain things that from day one we weren't going to move on, and we didn't. And I think that strong signaling value from day one, listen, we can't encumber other assets for a non-core platform deal or whatever it may be. If there were other nuances for our deal, we just held the line, and it was, in the first term sheet, and it was, there the whole time, and it's impossible to, you have a much stronger position, and you won't move on it. And the other side will be reluctant to ask for it even later if you've kind of been consistent the whole time. So I would do so.
Awesome. Nana, last thoughts?
I don't want to echo what's already been said, but certainly absolutely agree with being clear about who you are, where you want to focus. Also, making sure that you've identified and are building a relationship with a champion. And I guess don't lose heart, I guess would be my, BD deals. It takes a long time to get through them. There are moments where it's a little sticky, but staying persistent and continuing to build the relationship and stick to whatever those real those pillars are that you're going to use to guide your discussions is pretty critical. In the heat of the moment, it can get really exciting when you actually get caught up in the mechanics of the deal itself, but it's always important to stay true to your principles.
Cool. Well,
I know we're right out of time. I guess one quick thing is if you do a financial analysis, it's always going to say fund forward. It's never going to say do the deal. It's always more valuable into the future. But just remember that even in active financing environments, it's not just the capital, it's also the capabilities. And so be careful in terms of making that decision and really think through, can you actually execute as you fund forward, or is now actually the right time to do a deal?
Cool. With that final thought, we're out of time. I appreciate everyone joining us today. As a reminder, a link to the recording will be sent via email to each participant. If we didn't get to your question, which I don't think there were too many, but we covered a lot of ground, we'll do our best to answer it in writing. We look forward to seeing you all in person, hopefully very soon. In the interim, please continue to stay safe and do the great work that our industry does. So thanks and have a great day.